One of the important aspects that my channel has is transparency. For me, it's important to not sugarcoat things and show the good and the bad of my investing journey. In this video, I'm going over the companies that I am currently at a loss from smallest to largest, covering why are they down, analyze the fundamentals, and see if I will continue holding them. So if you like a real investor investing in full transparency and showing every step of his journey, consider subscribing and liking this video. It helps put my name out there and grow the channel as well. Let's dive in. The first company that I am down is Johnson & Johnson. I currently own 7 shares and I am down a little over 4.4%. Year to date, the company has been flat, meaning that in terms of stock price, investors has not seen any sort of capital gains this year. Johnson & Johnson has remained flat due to a combination of financial and legal challenges. The first reason is legal issues, the talc lawsuit to be more specific. J&J is in a significant legal battle over talc-related lawsuit, which claimed that its talcum powder causes cancer. Despite reaching a proposed $8 billion settlement, the company's effort to manage these liabilities through a subsidiary bankruptcy are being contested. Since this has taken a while to resolve, uncertainty and potential high payouts have negatively impacted investor sentiment. For the second reason, in its latest earnings report, J&J revenue beat expectations, but the company faced a sharp drop in net earnings and earnings per share. Adjusted earnings per share fell significantly year over year, partly due to increased research and development expenses. Additionally, certain key pharmaceutical products are facing competition from biosimilars, which has dampened the growth prospects of the business. The earnings per share dropped from $1.93 to $1.11. The third reason is broader healthcare sector dynamics, coupled with J&J legal liabilities, have amplified concerns about the company's future profitability. Investing in healthcare is not easy, and definitely it adds a layer of risk. The lawsuits, the research and development, the patent expirations, it gets to the point that it adds up in a negative way. J&J is approaching a critical spot, I would say. Revenue with a slight increase, but the rest of the fundamentals either flat or with a slight decrease. In order to know how bad the situation is for J&J, we need all the numbers, and the numbers that is missing is the settlement. Without that number, we cannot see the full picture, but based on fundamentals only, it is not looking that great. For now, my position with J&J remains as a hold until we have all the data. I am not adding, I'm just collecting the dividends and manually investing it in better opportunities. The next company that I am down is Pepsi. I currently hold 5 shares and I am down almost 7% with this holding. The stock price has been flat throughout the year with a recent decline, putting the stock in a 6% drop. Despite being Coca-Cola's long-term rival in the beverage industry, Pepsi owns Frito-Lay's, which gives them an advantage in having participation in the snack industry. Now, one of the reasons that made the stock decline is mixed earnings. Despite having a modest 0.8 increase in quarterly revenue to $22.5 billion, this was slightly below analyst expectations of $22.6 billion. Key segments in North America face challenges, with volumes down 4% for Frito-Lay's and 3% for beverage. Despite positive growth in international markets, the domestic slowdown in these core categories weighed heavily on the results. Now, despite having certain fundamentals move in the right direction year over year, the improvement was not enough to offset concerns about slowing top-line growth, making the stock price to remain flattish. Pepsi is another hold in my portfolio, going through a slight decline, which I believe Pepsi will overcome this obstacle in the future. Currently not adding unless I see a bigger decline. Nike is another company that I own in my portfolio, having 7 shares with an average cost of $85. It puts my total return by almost 9% down. Year to date, the company has been doing very badly, down 27%, which is a huge loss for investors. Between the CEO Nike had and the surge of other brands, it has put the stock into an immense downward pressure. One of the reasons from this downturn is intense competition from emerging brands like Hoka and On, which has gained market share by offering innovative products that resonate with consumers. Nike somehow didn't invest better in the running club boom. This gave the sufficient part for other brands to attack, and they have achieved it. Another reason is that fundamentally the revenue has remained flat and the net income is lower than 2 years ago. The free cash flow has increased, but also the stock-based compensation. Investors don't invest on what the company is doing now, but what will do in the future. And that brings to point number 3. For guidance, the company usually mentions if they will do good, bad, or remain the same. For Nike, the company withdrew its full-year financial forecast and postponed its Investors' Day, signaling uncertainty about the future performance and causing concerns among investors. Nike needs to make changes, and in my opinion, they already started. Despite not providing any sort of guidance, they actually have a new CEO that knows more about the company than the previous one. All we have to do is wait and see how this new CEO executes a new strategy to bring this iconic brand to new heights. I am not adding to Nike until the path is more clear. Now, let's go with my largest holding, but also my largest loser in my portfolio, Hershey's. Taking 10% of my portfolio with 14 shares, Hershey's is down 17%. This company has been in and up and down. At one point, I was down 22%, then down by only 5%, and now I am back down to 17%. Hershey's drop is due to several reasons, and one of them is slight revenue and earnings per share drop. Quarterly, both has dropped, reflecting weaker operational performance. The other one is high cocoa prices. The cost of cocoa, a primarily ingredient in Hershey's products, remains near historical heights, squeezing profit margins. When we look at the revenue per segment, we can see that the American confectionery, which is Hershey's chocolate business line, is the largest revenue segment. By having a margin squeeze, it makes that your biggest cash flow is bringing less money. For me, this is the biggest driver of price drop for this company. This makes the third point to go in line with the second point. When you have the profit margins of your largest revenue segments getting squeezed, this changes the outlook of the company. In this case, Hershey's reduced their guidance, and this has changed investor sentiment. In my opinion, Hershey's just need to slightly increase prices to battle off the cocoa price hike, or simply stay still until prices goes down. The drop in stock price is big, and to me, it looks like one of the best beaten up consumer defensive to buy right now. Fundamentals are fighting off the situation, and it looks like this company will prevail in the future. My position is already big. I'm adding very small tranches here and there, as my priority is to increase my other core holdings. And there you have it, all the companies that I own that are currently in the red. As investors, we have to confirm if the investments we hold continue to resonate with our investment thesis. Before making any decision, we need confirmation that supports that decision. For now, most of the companies remain on hold except for Hershey's, which I will be adding small tranches. Hope you enjoyed this video. Transparency is key for us investors when talking about our investments. It helps us learn, but also connect with others to let them know that us, the YouTubers, are not winning 100% of the time. Thanks for watching this video. If you made it to the end, hit like, subscribe, and I'll see you in the next one.